These lunch and learns are for educational purposes only. Make sure you speak to your financial professional because there is no such thing, and I will repeat this all the time, there's no such thing as the perfect investment or the perfect strategy or perfect life insurance, since I'm talking about life insurance today. I will always go over the pros and the cons, but this session today is going to be strictly on the benefits of permanent insurance. So I'm going to share my screen. Now, if you're a type of person that loves to buy term and invest the difference, me as a professional, I work with lots of companies that has awesome products that can literally, if you're a 40-year-old, you can literally get a 45-year level term. You can have level term up to age 85. And this product also has a cash value component, a return of premium component, and it also has a paid up part of the insurance. So if you're the type of person that loves to buy term and invest the difference, make sure you get at me or somebody from my team, and we can actually look and see if that's the best strategy for you. But today we're talking about the benefits of permanent insurance. So let me go ahead and share my screen. All right. So cool. So the benefits of permanent insurance, you have so many people who come, I have so many people who come to me, they're like, hey, I don't know what kind of insurance to get. And this is the reason why I'm doing these lunch and lives. Last week I did the benefits of term. It's very important. Next week I'll be doing the benefits or teaching you more about a personal private pension plan. So make sure you tune in next week. So let's go ahead and dive in. The benefits of permanent insurance. Now, here's a few benefits, you guys. It's coverage that lasts your whole life as long as the premiums are paid. That's very important. And of course, premiums are level generally. It remains the same for the whole life of the policy. And I say generally because there's different types of permanent insurance. It has a tax deferral cash value component for growth, and it also has a tax advantage withdrawal. So every time I mention permanent insurance, people are only familiar with whole life, right? So I want to make sure that you really understand the differences. So to give you guys an idea, you guys probably know about this, but whole life insurance is a permanent life insurance that only focuses on guarantees. So you have a guaranteed premium, you have guaranteed premiums, you have cash value growth that's guaranteed, and you have a guaranteed death benefit. And then there's another type of permanent insurance, which is universal life. Now, it's a permanent insurance for people who like more flexibility. It has cash value growth, but that can vary depending on the premiums paid, along with the death benefit, because you have flexible premiums. You also have index universal life, which is a permanent insurance that offers flexibility as well. And it still has a cash value component. However, it's tied to the performance of an index like the S&P 500 or the NASDAQ 100 or any type of indices that you have out there. This could lead to the cash value in the policy varying along with the death benefit because of the flexibility. And then, of course, you have variable universal life, which is a permanent insurance that offers flexibility as well. However, the cash value growth is tied directly to the stock market or an investment in a sub account. Growth is not guaranteed, and you as the insured, you take the risk on this investment and you take the losses. So that's totally on you if you decide to choose a variable universal life policy. So I want to talk about some popular uses of permanent life insurance. You'll hear a lot of stuff on the internet, TikTok, Instagram, on all these benefits. And I'm going to go over some of the benefits. Paying for college tuition. You can use permanent insurance for paying for college tuition. You can use it for a down payment on your first home. You can also use it to pay for a wedding for a child. I know they could probably become very expensive. Not sure. None of my kids are getting married yet. I'm sure they're thinking about it. Start a business. You might want to start a business or fund a business with the money that you have in there, like J.C. Penney. They actually did that, or Disney, or Walt Disney. So it's a lot of different uses. It could be set up for a deferred compensation plan. Those are very popular amongst people in the workforce. It can also be set up as an executive bonus plan. If you have a corporation and you have executives that work for you and you don't want to follow the ERISA laws and rules of like your 401k and stuff like that, you can have executive bonus plans. You can also have a retirement buy-sell arrangement for business owners, which is very important. If you're a business owner up here, make sure you have a business continuation plan and make sure you understand what's going to happen if you're going to sell it or if you're going to pass it down to your kids. All those things are very important. It can be used for an IBC concept, and you probably hear this all on the internet, infinite banking concept. And that's typically whole life, dividend paying whole life insurance if you're using an IBC concept. It can be used for what I like to call a deferred banking concept, and that's typically the IUL. It can also be used for an irrevocable life insurance trust or an ILIT. And last but not least, it can be used for our proprietary reverse banking method. And that's using leverage to actually help you build wealth and transfer wealth. If you'd like to learn more about that, just go to my YouTube page. So let's dive in. And I'm going to talk about one of the popular uses, and that's how a l.i.r.p can work. And a l.i.r.p, if you never heard of it, is a life insurance retirement plan, right? So as we dive in, I'm going to give you some key factors that you have to understand. Key factors is one, if you're going to do something like this, you have to think of it as an asset, not an expense. It's an asset, not an expense. Number two is you must structure this and fund this properly if you're going to set it up as a life insurance retirement plan. Number three, it must be a need for life insurance. That's why it's called a l.i.r.p, a life insurance retirement plan. It has to be a need for it. Another thing that you need to understand is it's long-term, worst short-term ever. It's not good for 2 years, 3 years. It's a long-term play. You're talking about 15 or 30-year time horizon. And another thing is there is a cost of insurance. There are fees and there are charges. And that depends on the riders that you might have associated with this particular plan. I also want to talk about some key benefits that you must understand when it comes to this. Compound accumulation. That's a good benefit. 6 to 8% average returns or more. That depends on the company, depends on the indices. It depends on the floor, which you'll learn more about, the cap, if you have a cap, or participation rates. If you're not sure about all that stuff, just reach out to me. But those are very important to understand if you decide to get into one of these products. Creditor safe is a creditor safe environment where you can't be sued, garnished, or levied when it comes to the funds, but you have to make sure you talk to your attorney because every state is different. It also has tax deferred growth and tax-free withdrawals. And you must, if you're going to do any tax planning, talk to your CPA when it comes to these policies. And has no market losses. That's what makes it so sexy for a lot of people. And you'll find out that market losses actually take a toll on the wealth that you're building. It also has liquidity before retirement. It's not like your IRAs or your 401ks or 403bs where you got the 59 and a half rule. So you can actually have liquidity before 59 and a half. And supplemental income. Guys, I don't believe you should have just one source of income in retirement. It's supplemental tax-free income. So the last thing is it's a permanent death benefit, permanent living benefits. So now I want you guys to pay attention. If you're taking notes, make sure you do it right here. This is a hypothetical situation. Now I have to say that. Is an example using a preferred non-smoker, they're 30 years old, male, preferred non-smoker, using the S&P 500 numbers back-tested. That means from 1992 to 2022, it has a floor of 0.75. So you have a guaranteed floor of 0.75. You have a cap of 13%, meaning that if the market goes over that, you're only getting 13%. It's also, I want you to understand this. This is also using the expense report for this example. That means I'm taking out the cost of insurance, taking out the fees, and taking out the charges. And you're contributing, in this example I'm about to show you, you're contributing $6,000 a year for a 30-year period, then you're stopping. I'm also, and this is also based on a $500,000 death benefit. It has a living benefit, which has critical illness, chronic illness, things like that. And it has a long-term care rider. So if you ever get sick and you can't perform 2 out of 6 activities of daily living, it'll pay you 2% of the death benefit. Now, that's that. Now, I'm also going to show you an example of a Roth IRA, and that's based on actual market returns. It's still back tested from 1992 to 2022. However, I didn't take any fees out of this example for a Roth IRA. Just know that you have expense ratios that you're going to pay every single year. So you got to know that there's going to be some expenses involved. I didn't take any expenses out of this, but in the Roth IRA example, you're using $5,460 a year, right? And you're putting the other $540 a year into a 30-year term policy, like buying term and investing the difference. So let's go ahead and dive in. $500,000 death benefit, got the living benefit, you got a long-term care rider, right? So I'm showing these examples. The expenses are taken out of this, cost of insurance, the fees, charges. At the 10-year mark, you've contributed $60,000 because you put $6,000 a year. You got the $500,000 death benefit. So at the time of the 10-year mark, you got $68,735.56, right? Plus you have the $500,000 death benefit. Now these are designed and set up where if you die at that time, you get the death benefit and the cash value. Like I said, everything has to be structured properly. On the 20-year mark, you put in $120,000, still not bad, right? Cash value at that time, minus the cost of insurance, the fees, and the charges, is $213,522. And of course, if you were to die at that time, it's set up to actually pass on the death benefit tax-free and the cash value. And on the 30-year mark, you're done paying, you put $180,000 in, you have a total of $529,892.85. Now, same scenario, if you were to die without taking any cash, you got the death benefit and the cash value. So I want you to see those numbers, and I want to show you a 30-year term policy with a Roth IRA using the same market numbers from 1992 to 2022. At the 10-year mark, in this scenario, you put $60,000 in. We're comparing apples to apples, right? And just remember, apples to apples, however, you're putting in $5,460 into the IRA, and the other $540 is going for your $500,000 death benefit for a 30-year level term. So you got $77,641.55 at the end of that 10th year, right? On the 20th year, you put in 120, same thing, apples to apples. You have $192,928.47. Now you're probably saying, well, why is that lower? Remember, you're getting the full returns of the market, and you're also getting the full losses of the market. Now, what happened? You're probably saying, well, what happened was 2008 happened in this scenario. And then on the 30-year mark, you put in the same 180,000, you have $606,229.21. Now, you have that 30-year term, which was really good. It protected you. You built some wealth. You pay. Now, if you decide, this is very important that you understand this. This is why I do these educational seminars, so you can understand you have to make choices from now and for the future. So at this point, you paid $540 a year for a $500,000 term, 30-year level term. And if you decide to keep this term, you're going to end up paying $10,205 a year. So you have a few choices there. Obviously, you can cancel the policy and say, hey, I have enough money. I'm going to just use that for my retirement. Or you can say, hey, I'm going to try to get another policy. Or you can convert it if you decide to at the time. So it's very important that you understand this. Now, this is just the last 30 years, y'all. If you participate in a full bull market where the market is killing it for 30 years, obviously the difference is going to look totally different than this $606,000. So keep that in mind. These are hypothetical scenarios. So I talked about the benefits. You'll never see me just talk about the good without the bad. The negatives to permanent life insurance is this. The cost compared to term is dramatically different. I say this to people all the time. It's not like it's dramatically different. So the 30-year term example is $540 a year. In that $500,000 example I use, So the minimum for this particular l.i.r.p is put into an IUL. You're paying $3,730 a year. You know, it's building cash value. I showed you the examples, but in this scenario, when it comes to the flexibility, because now you know that IULs have flexibility of premium, you have a minimum that you could put in of 310 a month, and you have a maximum of 986 a month to fund it in this scenario. Now you have to know if you're funding this thing at the minimum, you're going to have minimal cash value down the line. When you're setting these things up, you don't fund it at the minimum. You're setting it up for a life insurance retirement plan. So make sure that's a negative if you're just doing the minimum in here. You have to fund it properly. Now, another negative, guys, if it's not funded properly and it's not funded long enough, it could lapse the policy. So you'll end up having no insurance. And if you can't pay for this long term, horrible, right? Typically, it's not enough to handle your life insurance needs alone. So you might need a blend of term if you decide to go this route, right? To cover your dime, which is your debt, your income, your mortgage, and your educational expenses. So that's another negative. If you might not have enough to cover all of your situation if you were to pass away. So a blended policy might be a good idea for you. Surrender time period is anywhere from 10 to 15 years. That's why I said long term, great. Short term, horrible. If you surrender the policy, you have to know this. If you say, hey, you know what, after 20 years, you're like, hey, I'm just going to take all my money. It could lead to a taxable event for policy withdrawals that you've taken out in the past. So it's very important to be mindful of these things. And another negative, well, here's probably one of the most important things, guys. It's very important. Always ask your financial professional the good, the bad, and the ugly when it comes to your life insurance products, your investments, and your investment strategies. Now, I have a side note before I go. I'm going to tell you guys, look out for potential red flags. If your professional is only beating up a product without telling you the benefits of the product, he or she may have a biased opinion and may not be looking out for your best interests. Make sure you're dealing with a professional that's going to tell you the good and also that's going to tell you the bad. Because like I said, there is no such thing as the perfect product or perfect investment. Because if so, your advisors, your financial professionals, your life insurance agents, they'll be all out of business. So that's why it's important to understand your needs and the good and bad about everything. That's my time, guys. If you missed this, I want to make sure that you guys go to my YouTube. It'll be up there later on today. Got a lot of educational stuff on YouTube. I'll be doing a whole lot more just impromptu live so we can do some question and answers next time. But I want to make sure that you guys have the benefit of the lunch and learn. Learn while you're eating lunch. I'll talk to you guys soon. Have a good day.